All right, as I said, my name is Annie Swingen. I'm Director for External Relations at the American Foreign Policy Council. Today, I'm joined by Subir Lall and Mamuka Tsereteli. Svante Cornell, CACI Director, unfortunately is under the weather, so Mamuka has graciously offered to step in and serve not only as a panelist, but also semi-moderator. So Mamuka, I will kick it to you.
Thanks, Annie. Thanks, Subir. Nice to see you on screen, and welcome to everyone who is listening and watching us. As Annie said, I'm a senior fellow here at Central Asia-Caucasus Institute at American Foreign Policy Council. And it's my great pleasure and honor to continue this wonderful tradition that our institute established, I think almost 2 decades ago, when we invite executives from International Monetary Fund to present a regional economic outlook for the region. And today we have Dr. Subir Lall, now already long-term friend of our institute. And we had many sessions like this in the past. Subir is a deputy director for the department that oversees Middle East and Central Asia at International Monetary Fund. He worked in different parts of the world, including Western Europe, Eastern Asia, and now is responsible for this very interesting, vibrant region, Central Asia and Caucasus, in a very turbulent time for the region when, as we all know, Russia invaded Ukraine, and the spillover of that conflict is felt everywhere in the region. And its timing of recovery period after COVID and other geopolitical events that are happening in the region, developments with Iran, with China-Russia dynamic and China-Central Asia dynamic. So we have this interesting context, and plus internal developments in the region. Some of the countries are accelerating their reform policies. Some of them are more maybe reserved in these difficult times and waiting for outcome of this geopolitical turmoil in Eastern Europe. So we have very interesting environment context, and it's I think right timing to hear from our friend Subir Lall and from his presentation that he and his colleagues prepared about economic outlook for our region. And I'm sure we'll have some questions and some time for discussion. It's 1 hour session, but we'll try to squeeze and utilize as much questions as we can. Subir, the floor is yours. Thank you.
Thank you very much, Mamuka, for your kind introduction, and thank you, Annie, as well. It's nice to see both of you. Indeed, we always benefit greatly from our participation in what is now a tradition at the Institute. And good morning also to those of you who are able to join us for this biannual tradition now, discussing the outlook for the Caucasus and Central Asia. So given that we have limited time, let me move on right away to my brief presentation, and then we can have some time left over for if there are any questions or for the discussion, if that's okay. So here we are, and here we go. So if you've joined us in the spring, you will know that the broad theme was about spillovers, and that's in the next slide. And in fact, what we found is that the adverse spillovers that we feared at that time, fortunately, did not materialize. So turning to the first slide of the presentation, what you can see here is that despite the war in Ukraine that Mamuka mentioned in his opening, and which is of course on all our minds, the region has continued recovering quite robustly in early part of 2022, this year. And it has made progress in recouping the lost output from the COVID-19 shock of 2020. Output expanded, but somewhat slowly at a slower pace in the first part of 2022, as might be expected after the big rebound last year. Because output has in fact surprised on the upside, our growth projections for this year as a whole, which are shown on the right-hand side chart, have been revised up significantly compared to April when we were discussing the outlook last time. And in some cases, in fact, to levels above what our projections even were before the war. For instance, in Armenia, Azerbaijan, Georgia, and Tajikistan. The details of the country-specific projections are available in our regional economic outlook for the Middle East and Central Asia region, which is available on the IMF website. So in the next, with the stage set that growth turned out to be quite robust, let's move on now to see some of the factors that explain why the impact of the war has been milder than expected. Of course, the main thing is the region has close links to Russia, economic and trade linkages. And we had identified a number of spillover channels at the start of the war. On the left-hand side, you can see the direct spillover channels. For example, trade remittances, tourism, and financial linkages, including foreign direct investment, cross-border banking, and payment systems. In addition, there are a number of indirect channels, including and global factors, including commodity prices, global risk aversion, global growth, and the tightening of global financial conditions. Now, what has happened, as you see in the next chart, is that the downside risks did materialize since April. For instance, if you look at the leftmost chart, commodity prices remain high. Food prices have returned to pre-war levels, but remain well above the levels in 2021. And of course, high food and fertilizer prices create food security challenges for low-income countries and vulnerable population groups. Oil prices have been volatile and are projected to remain high, almost 40% higher than last year in 2021. Now, in the middle chart, you can see that global financial conditions have tightened faster and more sharply than expected. And that's as a result of monetary policy across the globe tightening at a faster pace than was envisioned in response to the initial surprises on inflation that we saw worldwide in the early part of this year. And the Global Financial Conditions Index we follow is now at the highest level since September 2020. And with the tightening seen faster for emerging market countries than for advanced economies. And global risk aversion has also increased. And so there are widening emerging market sovereign bond spreads and increasing portfolio outflows from emerging markets. And finally, high frequency indicators, which you see on the rightmost chart, point to a slowdown in global activity this year that is broad-based across manufacturing and service sectors. So the overall picture is one where many of the downside global risks that we had identified back in April have in fact materialized. But what happened and what you see and what we see actually is that these were more than offset by other factors. And that explains why on balance things turned out to be better than we had feared back in April. And so there has been a more positive contribution than expected when the war started. Economic activity in Russia has turned out to be more resilient than was anticipated at that time. And clearly that has been an important driving factor for the countries in the region. A related factor, and that you can see on the right-hand side, is that money transfers into several of the countries in the region, including Armenia, Azerbaijan, Georgia, Uzbekistan, have surged this year. And these transfers, which include remittances, contribute to growth in banking deposits and in local currencies, reversing the initial post-war losses against the US dollar. Correspondent banking relationships have been sustained, including as a result of regulatory compliance efforts and reliance on invoicing in the ruble. And finally, financial market tensions have abated. As you can see here, if you look at the currencies on the left-hand side, for the region, they've generally more than recovered the initial losses against the US dollar. but not against the ruble, which has appreciated strongly against the dollar. You don't see that in the chart here. And that, of course, has implications for some of the imported inflation that countries are facing. Similarly, on the right-hand side, you can see that while sovereign spreads initially overshot relative to the global MB index, they have been decreasing in recent months. So as a result, what you see is that the overall picture is one where the external position and domestic demand have both been stronger than originally expected for this year. And there are a number of explanations for this. In terms of the export demand side, the region, the Caucasus and Central Asia region, appears to have benefited from trade diversion between Russia and the West. And international sanctions created import and export constraints for Russia. And these countries in the region appear to have filled the gap to some extent. Re-exporting to Russia as part of the customs union is one factor, and offering substitutes for some goods such as metals and minerals and services, IT services that were exported by Russia before. And the European Union and the US have also intensified their relationship with the CCA countries of the region, and there's been a reallocation of companies and workers in some cases that have been employed by multinational companies. So the large current account surpluses for the oil exporters in the region and the somewhat improved current account positions for the oil importing countries, especially the low-income countries that have benefited from sustained remittances and other transfers, also are evidence of this robustness on the external side. In addition, domestic demand has driven growth in some of the countries. It's quite remarkable if you look at the right-hand side chart, how much, for example, Armenia and Georgia have benefited from accelerated money inflows. And that has fueled a surge in domestic consumption as well as investment. The result of all this, in terms of the robust external demand as well as on the domestic side, has been that, and in addition to developments in food and fuel prices, is that inflation has remained high despite tighter monetary policy. And so average in July, it was almost 13%, and food inflation has been the main driver. There's also some evidence from the diffusion index that you may be able to see in the chart on the left-hand side, that the inflation has become more widespread across categories and products. And that's what the diffusion index captures. On the right-hand side, you can see that countries have responded, and in many cases proactively responded by tightening monetary policy and activated fiscal measures in some cases to respond to rising inflation and exchange rate pressures. But so ex-ante real interest rates have risen in the region, but inflation still remains on the high side. Turning now to the outlook. Going forward, this has been a surprisingly strong performance this year, but we expect that next year activity will ease, and the risks are also high. As you can see from the charts on this slide, and based on our most recent round of forecasts, real GDP growth is expected to slow next year in 2023, especially for the emerging markets of the region, given that the headwinds from the war in Ukraine and the global slowdown take hold, and some of the one-off factors that provided a boost to growth in this year, in 2022, are expected to fade. For example, the very high oil prices, and you're already seeing some of that happening in the commodity markets. And also because monetary tightening is expected to have some impact on curbing domestic demand. And so one can expect naturally an easing of activity. Medium-term growth, as shown in the middle chart, is also expected to be subdued relative to historical averages and to peer countries. And this is to some extent also related to the deterioration of the medium-term outlook for Russia, which is likely to be less of a driver of growth in the region, with sanctions and reduced trade and financial linkages expected to remain present for an extended period of time. And then finally, on the right-hand side, you look, is an illustration of the long-term growth trend. It has declined in recent years. In fact, it was above the emerging markets average, 2015 average, the European emerging market countries, but no longer is this happening. And in fact, growth is in the region is not sufficient for income convergence, partly due to high rapid population growth, and also due to weakening underlying potential growth. Turning to the next slide, the outlook is, in addition to the baseline being more subdued, including over the medium and long term, uncertainty is quite high and the downside risks still dominate. This is driven by exceptional uncertainty amid the confluence of shocks that we have been discussing for some time now, and that could have a deeper impact, including on the regional economic performance. There are upside risks, including based on food and commodity price moderation, if that were to happen, and for oil importers, a greater than expected decline in oil prices. However, this is dominated by downside risks, which are more numerous and potentially more powerful. One is, of course, the persistence of inflation due to external cost push factors, which in fact, that's also a broader risk worldwide of persistent inflation, tighter global financial conditions. In addition, in the region, exchange rate pressures, a fragile anchoring of inflation expectations, and weak monetary transmission could all contribute to persistent inflation. In the region, food insecurity and social unrest is an additional risk factor, given if high commodity prices were to persist and if there were to be food insecurity, that could lead to both social pressures and fiscal pressures as well. One of the other important factors is tighter than expected global financial conditions that could worsen debt dynamics, raising funding pressures and financial stability risks. And of course, heightened global risk aversion typically also aggravates exchange rate risks and financing risks for countries. Now, the spillovers from the war could also reduce progress in reducing poverty and inequality. Poorer countries and households are most at risk from rising food prices and lower remittances. So that's a risk factor we could see materializing if the shock were to persist for a longer period of time. And in addition, disinflationary policies that are being implemented could be more costly in terms of weakening output, and could also weaken external conditions for the region as well. And finally, a persistent slowdown in China could affect countries with direct trade linkages, and that could have spillovers on other countries in the region. Finally, and briefly, turning to policy recommendations. So there are a combination of near-term challenges, and as mentioned, there are also medium-term challenges. And very briefly, there are four main pillars to this. The first, as elsewhere, restoring price stability is a priority to alleviate the costs to households and businesses, especially in countries where inflation is broad-based and expectations are rising. And monetary policy would, of course, be the main tool to address this. Hand in hand with that, protecting the vulnerable and preventing a worsening of poverty and inequality would be important. And priority in this context should be given to temporary and targeted cash transfers to those that most need it, and to ensure the efficiency of social spending. Ensuring fiscal sustainability also remains important in making sure that, and this can be done by prioritizing spending and reducing fiscal outlays. In many countries, fiscal buffers were eroded dealing with the COVID-19 pandemic, and fiscal buffers need to be rebuilt to be able to manage future adverse shocks. Oil exporters should maximize the benefits from the windfall by building buffers as well and progressing towards diversification. And where fiscal space is very limited, fiscal adjustment needs to be accelerated to ensure debt sustainability. And in addition, there are other policies that can be undertaken to address some of the challenges, including on scaling up agricultural production, for instance, by improving access to fertilizers, investing in climate resilient agriculture. In places where asset price dynamics are a concern, macro-prudential measures should be employed to manage credit and asset price booms. And low-income countries may need to address lingering pandemic risks as well, because vaccination rates are low, and that could pose a risk in the future. Turning to medium and longer term reforms, it is important to strengthen the resilience of the economies, including by improving monetary policy frameworks to strengthen the credibility and effectiveness of monetary policy, the importance of which highlighted just through the developments in this past year. And it's also important, again, to strengthen medium-term fiscal frameworks to maintain and bolster confidence in fiscal dynamics, ensure that there's fiscal space available, and secure fiscal sustainability. And to, I would say, modernize and upgrade the social safety nets to improve their coverage and effectiveness, while also being fiscally prudent at the same time. And so moving away from generalized subsidies, improving the cost effectiveness of social spending, and building resilience against future shocks. The development of a larger and resilient private sector, which is needed to drive growth, also requires the removal of entry and growth barriers for firms, and inclusion of more youth and women in the labor force, and efforts to reduce informality. And there are multiple measures that can be done that can bolster inclusion while also supporting private sector-led growth. And over the longer term, very briefly, productivity enhancing reforms are going to be important, including to help advance the unfinished transition to a fully market-based resource allocation supported by an appropriate safety net, and economic diversification, and a transition to a more sustainable and green policy framework. And there are some encouraging signs from recent shocks that have accelerated the efforts to diversify trading partners and routes, participation in global trade, and aligning domestic institutions. But these efforts need to continue. These remain very important medium-term priorities. As you saw in one of the earlier charts, the medium-term potential growth prospects for the region are not great, and those need to be addressed mainly through structural reforms to make sure that living standards in the region converge to those of peer countries in other regions, including in emerging market economies in Europe and elsewhere. So let me stop here. And this was a quick high-speed presentation and overview. Mamuka, back to you, and happy to discuss and elaborate further, or take questions as well. Thank you.
Thank you. Thank you. I think this was very helpful. Definitely, we have now understanding of IMF's outlook for the region, and this is interesting in many different ways. But let me start with a couple of my own questions for the audience. I can advise that you have a question and answer function on your Zoom screen, and you can ask questions. And I already see a couple of questions there. But before going to our audience, I have a couple of questions of my own, Subir, if I may ask. Let's start with one of your last points, and this is a subject that I'm interested greatly in general, and I think it's very applicable to definitely for our discussion today. You mentioned about entry barriers for firms. And we all know that growth of economies in like elsewhere in the world, in this region, will depend, as you mentioned, on private sector development. And you mentioned entry barriers. You also mentioned some of the structural or other kind of reforms that may facilitate the process. And we had this discussion in the past about role of the state and privatization of state assets and so forth. But let's start with the maybe barriers. When we talk about barriers, can you specify what are those, so that maybe our audience would understand it a little bit better? And because understanding barriers would help us to understand how to remove them.
Indeed. Thank you for that question. It's a very good question. So just to step back for a minute, we know, of course, that ultimately growth and job creation has to be driven by the private sector, because that's where the investment can come in using private savings globally. In fact, because given the fiscal constraints, it's not possible for the public sector to keep investing at the pace that is needed to create jobs for a rising population and growing labor force. So what are the barriers to entry? There are both explicit and implicit barriers to entry. Explicit barriers can be, and we see that in a number of countries, is that the requirements are quite onerous in terms of getting the necessary permits, for example, to set up businesses. And those become problematic. For instance, access to land becomes problematic, and if that is not available, or getting all the required building permits, as it were, or if there are other things, there are also implicit barriers, which, of course, for instance, for any investment to succeed and thrive, one needs access to both the ability to hire people and labor, as it's called in the sort of economic theory, and access to capital. And sometimes that is not necessarily very easy, especially for new entrants. And so there are reforms required to make this access to capital and to labor easier. There could be labor laws that prohibit it, or very onerous requirements, again, there, that essentially deter big investments, or deter, as a sidebar, most of the job creation and income growth that happens, in fact, worldwide, is when small firms become big. And it's not driven by the big firms that are already established. They tend to not grow as much. It's the small firms becoming big, and that's actually a feature also in advanced economies. So if there are disincentives, and that's part of the barriers in terms of moving up the scale from, maybe there are reasons why you don't want to become a firm bigger than, say, 5 or 10 people, because then it'll attract undue attention from the government. And there could be things like that prevent firms from growing. There are other impediments as well. You mentioned, Mamuka, the role of the state. And one of the things of the role of the state is the role of state-owned enterprises. And they are often dominant in sectors, and that creates an implicit, almost monopoly. It is very hard for a new entrant to come in and take on the competition or the competitive landscape, especially if the SOE benefits from some fiscal or other implicit subsidies that do not create a level playing field. One other point that we have tried to emphasize is also on the question of governance. For instance, what is, if, one of the big activities is, of course, public procurement. If small or new entrants don't have access in a level playing field to the same contracts, they are not going to be able to participate. It just basically goes to either well-established firms or, in fact, other government entities. So these are the sort of the barriers to many of the barriers to entry that can prevent small firms from taking hold and from growing and contributing to employment and income growth. Sorry, that was a very long answer, but it's a very good question and actually covers many different facets. I only touched part of it.
Exactly, and I'm glad to hear some of your details in answers, because that's absolutely essential. You mentioned state-owned enterprises. We all know that. I repeat it like all the time, but we all know that too much assets are still in the hands of states and in different forms, whether it's land or state-owned enterprises or so forth. And these are like less productive assets right now that could turn into more productive assets if they're privatized, if they're utilized in different other forms. Let me now move to some of the questions from audience, because they correspond to some of my own questions. So we'll start answering maybe some of that. The first question is from which countries are, this is from Tsereteli, from which countries are countries of Central Asia and Caucasus receiving money transfers? And obvious answer is obviously Russia, but it's not only Russia, right? Maybe if you can share some of your sort of views on that, Subir, would be great to know.
Well, indeed, Russia is by far the biggest source, because there are a lot of, for instance, workers. If you think from the Kyrgyz Republic or Tajikistan, other low-income countries who work in Russia and send remittances back to their home country. We do see some other sources of remittances, including, for instance, from the Middle East and other regions. There are, in fact, even some from further afield in Europe and the United States. But clearly, and the most important source of remittances, single country, still appears to be Russia. And from the recipient point of view, the countries that benefit the most from remittances seem to be Kyrgyz Republic, Tajikistan, Uzbekistan, and to a lesser extent, as a share of GDP, some of the others because they are bigger economies. But so they play an important role. One point to notice is in many cases with the remittances, these are, of course, a lifeline for the low-income households in those countries. And so that's why they become important when you're talking about remittances in the range of 20 to 30% of GDP. They have a very sizable impact on the living standards of people in the recipient country.
Yeah, I think, and also probably we should add here, it's interesting probably for our audience as well, that there are some regional countries who are also sources of remittances to other countries, like Kazakhstan for Kyrgyz or Uzbek or even Tajik, I think. And so yes, more advanced economies support other economies this way as well.
Indeed.
One other question I had related to that, remittances, in most of the countries we saw increase of remittances in recent past, and but I may be wrong, but my view is that most probably there is it's remittances, but there is also these transfers include funds that some of the people migrated actually back to their own countries after the war started. They may be going back to Russia in some cases, but there are other cases, I know other permanent cases of migration back to their own countries as well. So whether this trend of increased remittances will continue, I have some doubts about that. Probably it will stabilize and will be in the same level or maybe even lower level going forward in next years. But this is the kind of trend that was happening this last 8-9 months, that increase of remittances, as I realized. Is that correct observation?
Yes, no, absolutely. I mean, what the surge we saw this year is highly unusual, and it's very unlikely that it can be sustained over an extended period of time. Measuring these things in real time is also problematic because, as you mentioned, and some of them are remittances, some of them may be permanent transfers. A third channel is, of course, that what you're often seeing is many Russian citizens are moving to some of these countries, and we've seen evidence of that, for instance, in neighboring countries, including in Georgia and Azerbaijan and elsewhere. And so, of course, they move some of their assets with them and set up their own, especially, IT professionals and the like, and are setting up shop elsewhere. You're seeing that in the Kyrgyz Republic as well, for example. So it's very hard in real time to tell the difference between what's a remittance or a transfer of assets. And the other thing is, of course, that but I think it's safe to say that this is the rates we have seen in the recent past are not going to be sustained. So then that's on the short term. Now, the big question for the region is, of course, how these channels play out over the medium to long term, and what's going to be the impact of Russia and developments in Russia on the region. Say, if you're looking at a 3 to 5 year horizon, will we see, in fact, that some of the migrants who are coming, including not just the returning workers, but migrants from Russia, do they stay there? Do they set up businesses and set up alternative channels of employment and settle their families and earn income and so on? Or do they go back? Do you also see trade fundamentally changing in terms of patterns, and Russia not being so much the destination of trade, and in fact alternative routes being diversified? And whether countries, and many of these countries, as we know, are landlocked, not well plugged into the global trading system, are they able to do that? And this is all happening in the context of changing patterns of trade, and in terms of the greater role for more high technology trade, and whether countries are able to tap into that, where geography becomes less of a barrier than it used to. That's the longer term question. There are some encouraging signs, but it's too early to tell. But on your question on remittances and money transfers, in fact, one other aspect is you often see in the BOP what we call errors and omissions, which are not easy to classify yet, but eventually over time we figure out where they belong and which category. But certainly for now, a lot shows up in remittances. Thank you.
Thank you. There is our colleague from Voice of America, Maya K, is asking questions, one for you and one for me. One for you is about prospects of Georgian economic growth for 2023. If you want to answer that question, but meanwhile, I'll try to, before you look at that number, I'll try to talk a little bit about another question, that's a concern about a large number of migrants coming from Russia to Georgia, and whether this is cause of concern or not, and where this have implications in terms of not just economic implications, some of the direct benefits, but also security and other kind of political implications going forward. This is a subject of concern, obviously. It's interesting that I talk to people in different camps, political camps, and opinion is divided. Most of the people are still positive about the fact that some of the IT and other professionals are moving to Georgia from Russia or other countries, but mostly from Russia. There were some movements to Georgia from Belarus as well, and not just to Georgia, by the way. There's a large inflow of IT specialists to Armenia, to Uzbekistan, and other countries as well. So, and that trend is still ongoing, not in that same pace. More concerning is that I was looking at numbers, thousands of new business entities are established, again, not only in Georgia, but in Kazakhstan, Armenia, and other places, owned by Russian citizens, and how this will kind of reverberate going forward in terms of political environment, strategic environment. Definitely I see it as a in 3 to 5 years, we may see different kind of economic implications of this process, but there will be some political and security implications as well. It's a large projection of soft power potentially from Russia to other countries, and how that will kind of impact developments in these countries, we have to see. And there is some, as I said, ground for concern there. This point that some of these people are leaving country, that's correct. Not everyone stays in, the question was about Georgia, but not everyone stays in Georgia, not everyone stays in Armenia permanently, but there are a substantial number of people who are staying there as well. As mentioned, I know at least several American companies who moved from not several, but multiple American companies who moved from Russia to other countries, in neighboring countries, including Georgia, and they established permanent regional offices there, and they moved their workforce from Russia, but also from other countries now, and that trend is as well. It's a complex issue. I think it's too many details yet. Maybe at some point we need to dedicate special discussion on this subject going forward. But now back to you, Subir, if you have any projection numbers for Georgia or maybe some other countries that you see is interesting, because some of the countries grew very rapidly this year, unexpectedly, because of reasons that you described earlier.
Yes, indeed. Thank you so much. The thing is, I feel just on your last point, indeed, things are still evolving, and we could have a whole separate discussion on some of the longer term implications of the changes that are taking place. Coming to, and indeed, whether some of these changes are permanent or not, and I think it's really quite difficult to look too far out ahead with any degree of confidence at the moment. Coming to Georgia, so in Georgia we do have a fund-supported arrangement. So there's a program with the IMF, and so the economy has done very well last year and this year as well. Our growth really coming in at close to 10% this year. And it links back to one of the charts I showed earlier about the strong domestic demand that we have seen and the strong inflows. And one of the other aspects you can see from that is if you look at things like rental prices in the capital, for instance, you are seeing that they are rising. That means, in terms of the economic activity is quite strong. Looking ahead, the prospects are good. I mean, of course, it'll be very difficult to sustain these levels of growth. These are unusual bounces, but the medium-term prospects for the economy are good. In fact, we should have an update on Georgia, hopefully in a week's time or so, on our latest assessment as well. But if one looks at a number of indicators, growth is robust and will ease from this year's level, and the precise updates and the projections we will have for you later next week, hopefully. Inflation is high, but it is easing, and so certainly the central bank is very closely attuned to monitoring inflation developments, and so we expect that inflation will start is already coming down and will continue to come down towards the target of the central bank over the coming period. And on the fiscal side, certainly also Georgia has been maintaining, despite the strong upsurge in growth, very sort of responsible overall fiscal policies that will ensure that the debt situation continues to remain strong, and the exchange rate has appreciated this year, thanks in part to the money inflows, and it's also allowed the central bank to rebuild their buffers in terms of foreign exchange buffers. All these things are, taking advantage of a good situation to rebuild buffers, fiscal buffers, reserve buffers, and so on, bring inflation. So the policy mix is very much on the right track. That being said, there are, of course, reform priorities. We just spoke a few minutes ago about SOE reform, and that's clearly one of the main areas where attention is being paid and needs to be continued to be paid, and that's one of the core elements, in fact, of our program with Georgia. Let me stop here.
Yeah, that's thank you, Subir, for your answer on that issue. I think also probably end of, or at least partial end of COVID and recovery of tourist sectors will contribute to the exchange rate, definitely, and some of the
Indeed, I should have mentioned tourism as well. I'm sorry, I overlooked that, but tourism certainly has come back very strongly this year.
And some items of export is also kind of showing good sign of growth, so which is good. There's a very interesting question from Mr. Ben Slay, sorry. And this is about, I mean, he is asking same question about the longer term impact on economies of countries coming, I mean, from those movements of capital and people from Russia to other countries. We partly answered that question, but there's another aspect of it. Would Russia need more human capital going forward? And maybe because of people who are leaving country, particularly after this mobilization call in September, are younger males, and whether Russia will need migrant labor, more migrant labor even than before going forward because of this outgoing migration of Russian males. This is obviously sociological question, important one. I don't know if you have an answer.
More importantly than a sociological question is the fact that I don't have a good visibility on Russia and in terms of details, because my coverage is the region, the Central Asia-Caucasus region, rather than Russia. So in fact, you may be in a better position to answer that question. But certainly from the recipient side, I can say that some of the movements there are helping, in terms of the countries that are hosting them, in terms of benefiting from growth and increased spending and so on. And as we mentioned before, the question is, there are three different things that can happen, right? They can stay there and continue to contribute, and that implies a structural change in many of these economies. They may return, or they may move to third country destinations, and they're only temporarily here before moving on elsewhere, where there may be other opportunities for them. And to be quite honest, it's very difficult to definitively answer that question, but I will turn it back to you, Mamuka. You may have better insight on the Russian economy.
No, I'm pretty confident that in general, demographic picture of Russia is not very positive, as we all know. And even without this outflow of people, Russia needed more inflow of labor. That was a trend, and economic growth could not be supported internally with the growth of population in Russia. And that was always my view, in particular looking at Russian demographic picture in the last 2 decades. So with these developments in the recent months, after this, in my view, strategic miscalculation of Russian leadership that causes death of hundreds of thousands of people, Ukrainians, but also others. I think that that really turned picture into even much worse sort of direction. And no doubt that Russia will need inflow of migrant laborers, but that also will be determined whether this resiliency that you mentioned of Russian economy, Subir, will continue. Is that resilience that Russian economy shows right now? Is it really resilience, long-term resilience, or is it just temporary because of Russia still had lots of reserves and lots of financial and other kind of resources in place? Accumulated over the years, and how sanctions and other factors will impact this development, I think, will be critical. So it's very hard to predict, but in any case, I expect that there will be need for migrant laborers in Russia going forward. But the scale of that, it's hard to assess at this point. Here is the question from our fellow, from Rumsfeld fellow, that our institute administers, Central Asia-Caucasus Institute administers, Mr. Timur Naizbekov. He is asking a question about consumer debts and sustainability of consumer debts. Do you see it as a problematic, and do you see any need for government intervention to managing it?
Yeah, very briefly, because I think there are differences country by country, but overall, a rising household debt is clearly a concern. And what is required, though, is to first get a handle on exactly the magnitude, and sometimes that is quite difficult to do. So we recommend the authorities to get granular data on the household debt burden and use that to pursue risk-based supervision by the banks, because most of the borrowing is from the banking system. And so the way to approach it is to help build a supervisory capacity in the country, and especially among the financial supervisors, so that they can monitor this, have an idea, and recommend certain policy remedies where they are needed. And we certainly help a lot with technical assistance TA on that aspect. But it's something we do keep an eye on. But in terms of details, one is to get a good handle on that requires first having a good understanding of the granular data, and certainly we're encouraging the supervisors to do that.
Thanks. We have a question from Almaty. It's very late, so why don't we answer that question first, and then we'll come back to other questions again from Mr. Azamat Abdu Mamunov. Could you please give your opinion on how economic slowdown in China and Iran affect economic outlook of Central Asia and Caucasus in 2023? So do you think, obviously, impact of China is important for the region. Impact of Iran on economies of the region is more limited. But what's your sort of view on this, Subir?
Yeah, I know. Indeed, in general terms, of course, trade linkages matter, and one would have to look again country by country, and depending on the exposure that countries have. And as you said rightly, for most countries, the exposure to China is probably greater. So depending on developments there, they would have an impact. But I think it's important to put things in perspective, that there are a lot of moving parts here at the moment. This is a very unusual year. And so, and as we tried to lay out in the presentation earlier, there are multiple factors at work, and some dominate others. So I think it's more important to know the various influences rather than get overly confident on a very precise numerical estimate of what happens here, because things are still in flux this year, especially. So the short answer is yes, there's going to be an impact, but how much depends on the country in question, and depends on what our projections are for growth outlook for those countries, which itself is uncertain.
There are two questions from Mr. Nadim Hussein and Mr. James Preston. I think they're correlated. It's on state-owned enterprises. Nadim is asking about the future of this performance of these enterprises in Central Asia. Then question from Mr. Preston is, if in countries where privatization of major state assets has been accomplished, isn't it the key impediment to entry and the rise of private sector businesses, the Soviet era lock between vested private interests and members of the government protected by the judiciary? If so, how to address? You understand the point, right? So there's a major state-owned enterprises. Once they are privatized, they are still too close to government, and sometimes they're privatization is not the only solution in this, not the full solution of the problem. Let's put it this way. I think that's a point that Mr. Preston is making. But yes, in general, where you see this process going with the state-owned enterprises in the region?
So to put it in historical context, of course, the large role of the state and state-owned enterprises owes a lot to the legacy of the Soviet Union, but it also owes to the structure of the economy, the pre-information age economy, if you like, focused on heavy industry, focused on commodities, steel, intermediate goods, and where you could predict what that particular business would look like even decades into the future. And that was true worldwide as well. So what you ended up happening is that the state owned large parts of the economy which were considered critical for growth and for employment. The reality, whether we like it or not, is that that is changing. And the nature of manufacturing is changing. The role of services in the economy is changing. And so what may have worked in the, let's take broadly from the 1930s to the 1970s or 80s is not likely to be the engine of growth for the next 30 years, for example. And so it's not a question of whether it would be nice to have a reform, but that it's actually necessary to have these reforms in the landscape. And so part of it is because, to put it in many ways, the SOEs they use the, availability of capital in labor is limited in the economy, but they use resources, and some of these sectors may not be the most productive ones or generate the most return bang for the buck. One important point I wanted to make, and this comes to, I think, the second question. So I hopefully that answers Mr. Hussein's question. And now coming to the second one, Mr. Preston. There is a distinction between business-friendly reforms and market-friendly reforms. And I think I would like to emphasize that what is really important is having market-friendly reforms. Having, say a single private company, for instance, dominate a sector, and with different ownership, yes, it used to be the state, now it's the private sector, that has empirically not been shown to be as good, quite frankly, in addition to the governance concerns that are around it and sometimes the perceptions of corruptions that it generates. It is actually market-friendly reforms. And coming back to the point, Mamuka, we were talking earlier about barriers to entry and so on, the level playing field, those are actually much more important in terms of job creation, the most efficient allocation of resources, and growth, ultimately. So it is not that, it's just about privatization. No, far from it. It needs to be market-friendly reforms. And so we do see that as an important priority that needs a lot of institution building. And in fact, the fund is quite involved in that in terms of diagnosis and best international practice, including under our governance diagnostic support in many countries. To give you one very specific example, you may need reforms on your competition law and how the competition law is enforced to make sure that your sector is not dominated by one entity, whether it be a government entity or even a private owned entity. Just because it's in private hands is not going to guarantee that there is success. So as I said, the emphasis is really on market-friendly reforms rather than just a question of between who is the owner, public or private.
Yeah, that's, I think, a very important point here. And in general, this is like several other subjects we touched today. It's a huge subject for discussion, and this is very interesting, definitely, to maybe come back to this issue. Specific, maybe for the spring session, maybe we'll pick up one or two larger subjects, and we'll try to, in addition to Outlook presentation, we'll do also specific presentations, one of these, maybe on SOEs or maybe something else. One last question I had, Subir, is about, you mentioned these inflationary policies, interest rate growth and so forth. But also you mentioned, maybe you can comment very briefly on that. We're almost out of time. But also you mentioned subsidies, particularly on the food and so forth. It's not something that IMF usually supports, subsidies for some of the. Maybe just to clarify on that subject, what do you exactly mean by? As I recall, it was related to agricultural food support, right, and to the vulnerable parts of population.
Yeah, just to be clear, now ideally, what you would want to have a system that is targeted, so that market prices reflect. There's less of a subsidy element also for resource allocation, but make sure that food is the most essential thing for living, ultimately, in addition to shelter. Mm-hmm. And so people who need it need to have access to food. And so if one can identify them and make targeted transfers, that's the best possible world. Sometimes in the short term, especially, that is just not possible. And then one has to think, how does one deal with it? Either to make broad-based cash transfers or to make some kind of food subsidy. It's a second best option, but clearly food security, my point was already that food security is a very essential component and that needs to be preserved. And one has to look through what the available options are, and what's actually practically feasible. And in the very short run, and without the access to the proper databases of households and recipients, it may not be possible to do targeted cash transfers. And then there may be a temporary role for these subsidies, but they have to fit within a broader fiscal envelope.
Thank you. I think that's a very important point. And in general, I liked your earlier comment about focusing on, in order to ensure food security, focusing on agribusiness and agricultural development, regional agricultural development. This is, I think, very good sort of focus for governments to have, and in general, private sector as well. Agricultural products will be needed inside of region and outside of the region. So focusing on it, there are some, I think, good ideas that we can maybe again in the future discuss. I would like to thank now our audience for their participation. Many thanks to Subir for his insight and knowledge and finding time to share it with us. We'll prepare ourselves for the next session in the spring. Maybe focus on a couple of priorities that we discussed today, and maybe make it more kind of thematic, like we did several times in the past. But this is very, very helpful, and we learned a lot today from you, Subir, and thank you so much. And thanks, Annie, for facilitating this meeting as always. And thanks to our audience.
Thank you. And I will be obviously uploading this video to the silkroadstudies.org website. So for folks who missed it, you can share it. Thank you.
Thank you. Thank you so much.
Thank you very much. Thank you all. Bye-bye.